Good morning, everybody. Hope you're all well. 56%. That's how far Nvidia's free cash flow fell from the previous quarter. In that same quarter, revenue rose 18%. Same company, same filing, both numbers are true. And the reason matters. Nvidia gave certain investment-grade customers longer to pay on large multi-quarter agreements. So this is not a distress story. It's a timing story. And timing shows up again this morning in Australia, where fund exit terms changed before Australian property developer Lafield Group entered administration. Different market, different structure, same issue. The timing matters. Because this morning, the question isn't just about how much money moved, it's when. I'm Ryan Lafield. Today is Thursday, August 27th, 2026. Thank you for joining Universal Asset Owners Live. Let's get into it. All right, if there's one word doing a lot of work for us this morning, it's timing. We're starting with Nvidia, where the revenue headline and the cash story are telling us two very different things. Then we'll follow the money, look at one very large commitment number that needs to be handled carefully, and head over to Australia, where the order of events may be the most interesting part of the story. Along the way, we'll put a couple of those terms into plain English so the numbers actually mean something. So here's the big one today. Let's get underneath that Nvidia headline a bit. Nvidia says part of the answer is working capital. It gives certain investment-grade customers longer payment terms on large multi-quarter data center agreements. That pushed days sales outstanding from 45 days to 60, while receivables rose by about $22 billion in the quarter. Now here's the distinction that matters. This is not customers simply failing to pay Nvidia. The company chose to give some of them more time. That's trade credit. And it changes the timing of when the cash arrives. So when you put these two numbers next to each other, don't treat them like they contradict one another. Revenue tells you what Nvidia sold. Free cash flow tells you how much cash the business generated after everything moved through the quarter. And there's a strong counter case here too. Compared with the same quarter a year ago, Nvidia's free cash flow was still up 59%, and operating cash flow was up 57%. So again, this is not a distress story. It's a working capital story. The clock moved, the demand didn't. Let's put one piece of that into plain English. Days sales outstanding. Sounds more complicated than it is. It's basically the average amount of time a company waits to get paid after it makes a sale. For Nvidia, that moved from 45 days to 60. Now, normally when that number rises, you might start wondering if customers are struggling to pay. But that's not what Nvidia disclosed here. It says some customers were deliberately given longer payment terms. So the number went up because of a financing choice, not because customers defaulted. And that's why the number by itself doesn't tell you enough. A rising DSO can be a warning sign, or it can be a commercial decision. You have to read the note. The distinction is doing a lot of work in this story. All right, let's follow the money today. 3 moves this morning, and they're not all the same kind of thing. First, Vanguard is buying Altruist. The Wall Street Journal puts the price at about $4 billion. Vanguard says the terms were not disclosed. So for now, that number stays unconfirmed. Second, the U.S. Treasury is auctioning $44 billion of 7-year notes today. That one is simple. The auction happens at 1 o'clock Eastern, and the results are public when they land. And third, Nvidia named a multi-year memory partnership with SK Hynix. What we do not have is the published pricing for 2027 high bandwidth memory allocation. So we're not guessing at it. The useful distinction here is that one of these is a reported acquisition price, one is an actual auction, and one is a commercial partnership without published pricing. 3 moves, 3 different levels of certainty. That difference matters more than forcing them into one headline number. All right, the risk radar today. Here's the number that gets very easy to misread. Nvidia disclosed about $279 billion in supply and capacity commitments. 1 quarter earlier, that figure was about $119 billion. So yes, it more than doubled. But this is where we need to be careful. That does not mean Nvidia owes $279 billion. And it does not mean we should start adding that number to every other commitment schedule in the filing. Those schedules can represent different legal obligations, different triggers, different timing, and some may never become cash payments at all. So the right reaction to a number this large isn't how big can we make the total? It's what is the counterparty? What triggers the obligation? When does it mature? And what actually has to be paid off? Because once you start combining numbers that were never meant to be combined, you can manufacture an exposure that doesn't actually exist. Over to Australia next. And this one really comes down to the order of events. First, one quick term. A redemption gate is simply a limit on how much money investors can take out of a fund at one time. The fund can still be operating. The exit just gets narrower. Now here's where the timeline matters. On August 14th, Centuria Bass paused applications and redemptions in 2 credit funds, citing increased redemption requests. 11 days later, Australian property developer Bathla Group entered voluntary administration. So the gate came first, not after the administration, before it. And that changes the story. This wasn't simply a borrower failing and then every fund reacting. Investor behavior and the structure of the funds were already moving before Bathla entered administration. Then 360 Capital disclosed about 32 million Australian dollars of secured exposure. It says it expects full recovery on the information it has today. That is an expectation, not a settled fact. An MA Financials trustee capped monthly redemptions at up to 1% for August, September, and October. Here's the wrinkle. That fund says it has no Bathla exposure at all. So be careful calling this contagion. The Reserve Bank of Australia put private credit below 2% of Australian financial system assets in March. That limits any system-wide claim, but it doesn't erase what happened at the fund level. The exit terms changed first. One more story before we head towards the close today. The U.S. Army is moving ahead with a microreactor program worth up to about $2 billion across 5 developers. But here's the part that matters. The Army is not simply buying reactors. The developers will own, build, and operate them with payments tied to milestones. So what the Army is really buying is something the private market does not have yet, an operating record. That matters because infrastructure investors can't really underwrite a technology at scale until someone can show that it works, operates reliably, and has a track record behind it. The Army is effectively helping create that record. And one distinction to keep straight, the Army says more than 20 reactors could eventually be built. That is a program ambition. It is not 20 reactors under construction today. The first hard milestone to watch is a target date in September of 2028. One quick leadership signal out of Australia. The Future Fund is beginning a search for its next chief executive. Raphael Arendt leaves at the end of this year after 6 years in the role and nearly 2 decades with the institution. And the context matters here. This follows a strong year, roughly 15% performance, with the fund now around 290 billion Australian dollars. So this is a planned transition, not a distress signal. And in Britain, USS has hired Robert Ross from Cowsters to lead private equity funds and co-investments beginning in September. 2 leadership moves worth watching, but for very different reasons. One thing to take back to the desk this week, 2 schedules. For every private credit vehicle you hold, write down the terms that control how investors get their money out. Dealing frequency, redemption caps, notice periods, suspension powers. Then put that next to the longest realistic workout period of the loans underneath. And for every major AI counterparty, build a separate schedule. Payment terms, receivable concentration, commitments by year, investments, leases, and guarantees kept separate. Then ask one question. Which counterparties show up more than once? As a customer, an investee, a lessee, a guarantor, a financing partner? Because if the same name keeps appearing in different columns, that tells you more than one big headline number ever will. Not investment advice, just a page in the binder that may save you from a very uncomfortable meeting. Here we go, the allocation nobody made. Today it goes to the finance team that argued for shorter payment terms and lost. The customers got more time, the sale still closed, revenue went up 18%. The cash showed up later. And somehow, nobody wrote them a memo. Nobody ever does. And before we head to the back page, one quick note about who this brief is reaching every morning. It now goes out to 98% of the world's sovereign wealth funds, 18 of the 20 largest pension funds, all 10 of the largest charitable foundations, 85% of the largest family offices, and more than 100 billionaires. If that's the room already reading it every morning, come be a part of it with us. The full daily brief is free at universalassetowners.com. Every figure we've talked about today and every day is there with the source behind it. Finally, the back page. The sign behind the desk says liquidity available in small print beside it, subject to the dealing terms. And underneath, the cash window is open. The calendar decides how wide, which is probably the cleanest way to say it. The money can still be there, but that doesn't mean you can get all of it today. Somehow, that feels about right for today's theme. That's the show for this Thursday. Everything we covered this morning is in the daily brief. As mentioned, it's free. Once again, universalassetowners.com. And tomorrow, one thing we'll be watching closely. Chair Kevin Warsh speaks at Jackson Hole at 10 o'clock Eastern. No remarks have been published, so of course, we're not going to tell you what he's going to say before he says it. I'm Ryan Lafield. Thanks for watching Universal Asset Owners Live. Wherever in the world you're joining us from, have a great rest of your day and keep looking for the signals. See you tomorrow.